Welcome to our Australia's Centrelink deep dive with specific focus on pensioners. Today we're taking a critical look into the programs that are the foundation of financial security and health costs in Australia for pensioners. I'm Olivia Stone and my co-host is Jack Cosby.
Our goal today is to help you navigate the sometimes opaque world of Centrelink payment formulas, Medicare safety nets, and also the concession cards that act as vital keys to financial security.
These systems can seem impossibly dense, but they really hold the difference between manageable costs and financial distress for millions of Australians. Our podcast cuts through that complexity.
It does. We'll start with the recent policy shifts, notably that big announcement about deeming rates, and we'll also clarify those essential health safety nets.
By the time we're done, you should have some clear, actionable knowledge about where the rules are changing and exactly how you can maximise the assistance and relief available to you.
So let's jump right in. The financial mechanism that's been making headlines, the deeming rate.
Okay, so the core announcement from the government, it was a decision to increase the Social Security deeming rates by 0.5%.
That's right. And this change kicked in just over a couple of months ago on September 20th.
And it directly affects anyone receiving income-tested payments. So that's most notably one which is the age pension and two, the disability support pension.
And I think it's important to first define what deeming actually is because the term itself is misleading.
Centrelink doesn't care how much you earn on your financial assets, your savings, your shares, term deposits. Deeming is an assumption.
It presumes a set standardised rate of income from all those assets.
Wait, so if I have, say, $50,000 in a savings account and it's earning a tiny 0.5% interest, Centrelink might just pretend I earn 2.75% on it.
That's the mechanism exactly. That assumed income, the deemed income, that's what Centrelink plugs into your income test calculation. And if that deemed income pushes you over certain limits, your pension payment is reduced.
And we know from recent announcements what this new structure is going to look like after that 0.5% increase kicks in next year.
Correct. The system keeps its two tiers, the lower deeming rate, that's rising from 0.25% to 0.75% per annum.
And that applies to the first chunk of your assets, $64,200 for singles or $200 for a couple combined.
And then everything above those thresholds gets hit with the upper deeming rate, which is moving up from 2.25% to 2.75% per annum.
Now this shift feels significant, but the real context, the really fascinating part is this history of the decoupling between the Reserve Bank's cash rate and the government's deeming rate. Why is that context so important?
Well, it explains the political pressure and the government's motivation here. If you look back to 2010, the RBA cash rate and that higher deeming rate were perfectly aligned. Both were 4.5%. They were in sync.
Totally synchronized. But starting around 2012, they just diverged and dramatically.
The RBA cash rate fell quickly, but the government kept deeming rates high, which meant it was generating assumed income, often far above what people could realistically earn in the market.
So for years, retirees felt penalised because Centrelink overestimated what they were really earning.
Then we hit the post-COVID era, and the whole situation just flips on its head. Interest rates finally started rising.
The RBA cash rate shot up to 4.35% by 2023, but the deeming rates, they were frozen at 2.25%. Suddenly, the government was underestimating what people were earning.
So that freeze was a bit of a temporary benefit for recipients, but it created this massive gap. And so this new increase we're talking about, lifting that upper tier to 2.75%, is still 0.85% below the current RBA cash rate of 3.6%.
So the government is saying this is about realigning with real earnings. But given that the new 2.75% rate is still well below the current RBA rate, is this really just about alignment, or is it fundamentally about reducing expenditure on payments?
Look, it's a bit of both, but you have to think it's mostly the latter. Or maybe it's the government sort of testing the waters.
It brings rates closer to reality, but it crucially tightens the income tests. And that brings us to the most critical point for you watching, understanding whether you are assessed by the income test or the assets test. Because if the assets test is the harsher one for you, the deeming rate change doesn't matter at all.
Right, let's look at a couple, Pat and Richard. They have $600,000 in financial assets. For that amount, the assets test determines their payment.
It settles it at $539 per fortnight each. The deemed income gets calculated, but it doesn't matter. The assets hurdle is the bigger factor. They see zero change.
But then you introduce a defined benefit pension and the whole picture shifts.
Precisely. Let's stick with Pat and Richard. Same $600,000 in assets, but now Pat has a defined benefit pension. Let's say it pays out $32,000 a year.
Under the old lower deeming rates, the assets test was still just marginally the tougher one, so they still got that $539 per fortnight.
But now with the new rates, their $600,000 in assets is deemed to earn an extra $3,000 a year in income.
And that small shift is enough. It tips them over. Their total deemed and actual income is now so high that the income test becomes the harsher determinant.
And their payment immediately drops.
Immediately from $539 down to $515 per fortnight each. That's a reduction of $24 a fortnight each, driven entirely by this one change.
Anyone who is income tested and relies on that payment for things like, say, subsidies for aged care fees, will see those subsidies shrink as their deemed income goes up.
So your core piece of homework is checking whether you are income or assets tested. That determines your vulnerability.
Okay, that covers the financial policy side. Let's pivot now to the safety nets designed to cushion you from high costs when you're accessing health services.
Right, and these are mechanisms everyone in Australia should really understand, regardless of their Centrelink status.
We're talking about the safety nets for out-of-pocket costs, and we should start with the Extended Medicare Safety Net, or EMSN.
Its entire job is to kick in when you've had a lot of out-of-hospital services, specialist appointments, complex scans, etc. It's relief for that cumulative drain of medical costs.
One simple administrative step for Medicare, one that is often completely overlooked but absolutely crucial, is the registration step.
If you live with a partner or have dependents, you must register as a family or a couple.
And the frustrating but vital detail here is that you can't do this online. You have to make a phone call or fill out a paper form. It resets every January 1st, so if you haven't done it, now is the time.
You must do so in order to combine all of your out-of-pocket costs towards that one safety net threshold. If you don't, each person is tracked separately and it becomes extremely difficult for any one person to hit the limit. And the financial impact is huge.
There are two very different thresholds for the EMSN based on the January 2025 figures. For the general category and majority of the population, the threshold is $2,615.50.
That is a significant out-of-pocket spend before that net catches you. But if you hold a concession card or receive family tax benefit, the concessional threshold just drops dramatically to $834.50.
Wow, the difference between paying over $2,500 and paying about $800 before the system helps you is huge.
Yes. It's an immediate guaranteed saving of over $1,700 for the exact same medical services just by having a concession card and being registered correctly.
This is where we see the clear-cut benefit. Walking through an example using a typical specialist visit. Before you've reached your threshold, say you have a $92 consultation.
Medicare gives you a standard rebate of $40.40, so your out-of-pocket cost is $50.60.
And at $50.60 it adds up very quickly over a year, but once you hit that crucial $834.50 concessional threshold, the government then pays 80% of your remaining out-of-pocket costs.
Which means the total Medicare rebate for that same $92 consultation jumps from $42.85 all the way up to $82.90.
Now, separate to Medicare is the PBS Safety Net. This handles prescription medicines.
Yes, a parallel system, and it also resets on January 1st. The PBS Safety Net deals with the cost of the medicines themselves. For concession card holders, the threshold is set at $277.20.
Once you hit that cap, the medicines are free for the rest of the year. And for the general population, the cap is much higher.
It's $1,563.50. At the maximum subsidised price of $31.60 per script, that's about 52 scripts before that cap kicks in.
So a key difference here, though, is that unlike the Medicare Safety Net, which is automatic, the PBS system requires you to take action.
Once you reach your cap, you have to go to a pharmacist and formally apply for a PBS Safety Net card. Until you have that physical card, you will keep paying full price.
We've mentioned concession cards a lot, and they really are the key that unlocks that low $834.50 health safety net threshold and a host of other state and federal benefits.
Absolutely. Furthermore, the savings they provide on utility bills, council rates, etc., can be as financially important as a direct payment. Let's break down the three main cards.
Okay.
First, the gold standard, the Pensioner Concession Card, or PCC.
And eligibility for the PCC is straightforward. You get it automatically if you qualify for the age pension or certain other Centrelink payments.
Like the disability support pension, the benefits are comprehensive and national, reduced cost medicines, guaranteed access to bulk bill GPs, and of course critical access to that lower EMSN threshold.
The PCC also unlocks state-based concessions.
It can significantly reduce your property rates, motor vehicle registration, your electricity bills. It varies state by state, but the savings are substantial.
Okay, let's look at the second major card, the Commonwealth Seniors Health Card, the CSHC. This is where eligibility gets really interesting.
The CSHC is designed specifically for those who are of pension age but fail to qualify for the age pension due to the income or asset limits, etc.
It's income tested but not assets tested, which makes it very popular among self-funded retirees.
It provides the same discounts on prescription meds and some other state concessions, but there's another benefit.
Yes, I know the one you're talking about. A single person with no other adjusted taxable income could hold approximately $3.7 million in an account-based pension and still be eligible for this card.
The government wants to provide critical health relief, especially for subsidised medicines, to high wealth retirees who might have high medical needs but without forcing them onto the full age pension payment system, which would be far more expensive for the taxpayer.
And finally, we have the simplest card, the Seniors Card.
And this one is unique because it's managed by your state or territory government, not Centrelink.
For eligibility, you need to be 60 or over, a permanent resident, and no longer working full-time.
But you must check your specific state's rules because they do vary a bit.
And the primary benefit here is travel.
It grants extensive concessions in your home state, like the very popular New South Wales Gold Opal card. It also offers reciprocal rights when you travel interstate and gives you discounts with thousands of businesses, everything from retail to entertainment.
Okay, we have covered a massive amount of technical ground today, from the mechanics of the deeming rate increase and its historical link to the RVA cash rate,
to the powerful financial savings available through the Medicare and PBS Safety Nets.
And finally, the distinct eligibility criteria for those three main senior concession cards.
The key practical takeaway from all of this is if you are a recipient, the single most important action is to review whether your entitlement is being determined by the income test or the assets test.
And why is that the single defining factor right now?
Because the government has signalled a series of future deeming rate increases are coming. If you are currently income tested, maybe due to a defined benefit pension or high income from assets, every one of those future deeming rate rises will directly reduce your pension payment.
And potentially increase your costs for services like aged care.
Exactly. If your assets tested, then the deeming rate change is, for now, just a paper exercise. It doesn't affect your final payment. That distinction is crucial for your financial planning.
While policy changes like the deeming rate increase or OSCE grab all the headlines and cause the most anxiety, the massive measurable financial difference for you or someone you care about often comes down to administrative simplicity.
If you hold a pensioner concession card, are you actively maximising that lower extended Medicare safety net threshold by ensuring you're registered as a family?
That small step of making a phone call can guarantee you access to the $834.50 limit, providing instant, tangible financial relief for every single specialist appointment you have this year. The question is, are you using the knowledge?
Thank you for watching. Please share, like, comment and subscribe. Until next time.